Thank you, Blake. Thank you, Nick. Thank you, Stelios. And as Blake has said, I put time in to find interesting people that can edify the community, and believe I've done it again. And I'm about to pass the baton to Ernie Varitimos. Ernie, waiting for your screen to pop up and hear your voice. Great to meet you. Great to meet you, Ernie. Thank you so much for taking time out to be with us today.
All right, I'm going to switch over to a different
different screen.
I'm all set. You know, I'm on vacation, and I brought all my some of my computers over to the vacation house.
Okay.
So I don't have my normal setup, so it's not like just push the button and go.
All right. Are you going to share your screen and talk about things that you see, or you just want to talk about? There we go. All right. So yeah. Ernie, I read a little bit about you. I've been to your website, and I always like to start off, and I know your background. You said in your bio that you had about 20 years where you had, you know, some decent years, some off years. So, I mean, you really persisted in this business. I'm interested in how you were introduced to trading, what influenced you, and all the different, you know, the long and winding road you took for 20 years before you found a mentor that helped you with a breakthrough.
Sure. Yeah. Well, my career spans back a ways. I've got about 35 years as a, I guess, professional. I started out my career a long time ago, back in the late 70s, early 80s, working for Raytheon Research, designing laser-based inertial guidance systems for intercontinental ballistic missiles. So I guess that would have made me what you call a rocket scientist back then.
Right. And they say trading isn't rocket science, is it?
Well, I like to say that trading is the hardest profession in the world to make easy money.
Oh yeah, that reminds me of when I went to the floor in Chicago. A veteran pulled me aside and said, "Kid, this is a tough way to make an easy buck." So yeah, same philosophy.
It's finding your own way. That's the journey, you know.
Right.
In the beginning, I tried everything that everybody else was doing and had up and down success, but in the aggregate, it was usually down, trying to do what everybody else is doing. And so, you know, I guess you could take that sort of pearl of wisdom from the books by what's his name? Jack Schwager. Yeah, Jack Schwager in his Market Wizard books. And one of the things that really stood out to me, all these successful traders that he interviewed, none of them are doing things the same way, and they're certainly not doing things the way the conventional wisdom says to do them. And
Jack also reaffirms what you're talking about. I asked him, I've interviewed him, I don't know, 3 times now, and I said, what's the most important advice you could give to someone who's trading? And his answer was, find a trading style that fits your personality.
Well, that's exactly right. But, you know, there are certain universals that that I think anybody can adopt that will certainly help them along the way. But the most important thing is to, first of all, find an edge and know what your edge is, and then exercise good money management. But you know, that's kind of like tacit. I mean, everybody knows that. It's finding that edge, and then it's finding, you know, your own way. The thing that excites you, the thing that, you know, brings out the visceral reaction in you, and the thing that keeps you motivated. And you know, that's what it was for me, anyways. It's amazing that I stuck with it as long as I did, because I certainly paid my dues. I've literally lost hundreds and hundreds of thousands of dollars in my trading education, and most of that time it was because I was on my own, and it wasn't until I found mentors that helped sort of direct me.
Who were they?
Well, one I will mention by name. The other, I don't know if he'll want me to mention by name.
Okay, that's fine.
Yeah, the one that I won't mention by name, he was a very successful fund manager, traded mostly treasuries in his career, and made tens of millions, if not $100 million in his career. And what I learned from him was the reverence for money, and that really we're not in here to make money as much as we are to preserve our capital and then wait for opportunities. That it's kind of like, you know, waiting for money to be found on the ground and all you have to do is pick it up. You know, trading often is
therefore, less is more, right, Ernie?
Absolutely.
You know, and you know, that's one of the hardest things. I used to play Tom Petty's song, "The waiting is the hardest part."
Yeah. Well, I'll give you an example. You know, one of my favorite trades is the knob trade, and that's notes over bonds. And that's a yield curve trade where you're waiting for either a yield curve that is steepening or a yield curve that is flattening. And I don't know if you want me to go into any of the specifics about that, but essentially, you know, when the yield curve is steepening, your predominant trade is a long trade, or long notes over bonds, long the 10-year, short the 30-year. And that's a trade that has, you know, everybody seems to have a different variation of it. I take a very aggressive version of that trade, and it's been working for decades and decades. And then all of a sudden, over the past 6 months, it hasn't been working. And you know, it probably takes about 2 months before you sort of give up and decide that it's not working. But the best thing for me to do is just to leave it alone and just watch it and wait for it until there are, you know, that money on the ground that I can pick up again. Right now, it's dead money.
So it was your money that was falling on the ground the last 2 months. So how do you know? And do you have a parameter of when you're going to pull the plug on something that's not working? You know, when I raise money for money managers, to me, Ernie, you know, most people look at the performance, how well they're doing, who has the highest year-to-date returns. You know what I looked at?
What's that?
Their maximum drawdown.
Yeah, well,
that to me was more important, because everyone has drawdowns. All the greats do. You know, Paul Tudor Jones, Rich Dennis. You know, I mean, everyone has a drawdown. You probably even Ernie Varitimos has one once in a while. So to me, it's how you manage yourself on a drawdown, and if you have the discipline to know how to lose. Yeah,
and that's very dependent upon the actual trade that you're in too. But as a general rule, things that I'm trading systematically, I'm looking at my net profit as a percent of the drawdown, and my risk as a percent of the drawdown. So those are probably my most important.
So did you code your own algos for your system? I mean, you had the background to do it. I believe now it's not as discretionary as it probably was the first 20 years. Are you more on autopilot with what you've developed for trading ideas?
Yeah, can I tell how I sort of got into all of this?
Yeah, you know, sure, Ernie, this is America still.
Well, I just don't want to jump ahead and everything. So I just want to give a little bit of background.
Okay.
You know, like I said, I've been in technology most of my life, but technology as it applied to finance. And so many years ago, I worked for a lot of the big financial companies, like, you know, a lot of the big investment banks and others like, you know, Fidelity and others, and Bloomberg and Credit Suisse, and you name it. And I found myself being recruited by Sun Microsystems as their chief architect for professional services. And so during that tenure, most of my big clients were on Wall Street. And in fact, during the late 90s and early 2000s, we were responsible for building out most of the systems on Wall Street, including the exchanges and all the big investment banks and their systems. And so that's where I developed this affinity for finance. Of course, you know, I'm coming from a technical background.
Right.
But it wasn't until after I left Sun, which was after the .com bubble burst, and my stock options went from on paper being worth millions and millions to me, if I wanted to exercise them, having to owe them money. I decided to go out on my own and did a bunch of consulting, international consulting, helping companies meet their business goals and match it up with their technology, and did it mostly in the areas of finance and insurance.
I really don't want to skip over just that experience that you had. So, a lot of people, when things aren't going well, and, I'm sure even though it was on paper, you had no idea it could end up disappearing like that. And when people go through an event like that, some people will get into a fetal position and just keep dwelling on it and dwelling on it. And I'm interested in how you recovered psychologically from something like that and how you reacted to it. Did you take a hiatus, or did it make you more aggressive that, just like a lot of people that got caught long by financial planners in 2000 and 2008 and said, if I'm going to lose my money, I'm going to do it myself. And they became self-directed. So what was your reaction to that, and how long did it take you to emotionally recover from that?
Yeah, it's something like that. There's sort of the short-term view, which is a little bit more reactionary and a little bit more egocentric. And then there's the long-term view, looking back and saying, geez, would I have been better off just sticking with it? But at the time, that's how I felt. I was literally within 1 month of vesting several $1 million. And,
wow.
and so that really kicked me in the gut. And I knew that if I went back to consulting, I could make a pretty good living, making a few $100 an hour. And
Right.
I had the connections with, CXOs from Fortune 5s to Fortune 100s, and so I could keep myself going. And
Right.
so that's what I decided to do. At the time, though, there were a lot of political risks that were involved that made that whole journey very difficult. That was the era where we started to take on H-1B visas and bring in a lot of workers and talent from overseas,
Okay.
which severely diluted the market. And so what started out really good ended up being a real struggle, because my primary job then was resourcing and putting together teams overseas, and not necessarily putting some of my best talents to work, and having to compete much more heavily on
with the people that you were bringing over.
Yeah, I'm bringing over basic people to train to take over my position that will eventually take those positions at a much lower cost.
Right. Yeah. Okay.
But that was the work, and that's what you had to do.
See, this is why, Ernie, I say you can't learn experience. It only comes with the passing of time and living through stuff. Man, you've lived through some stuff, Ernie. You know what? You're a warrior.
Well, that's the big thing, is just to keep on plugging and trying to find new things, and heading in directions or finding a direction to head in is important. But being so stubborn and following that path until its demise is futile. And in every path, eventually, no matter how good it is eventually going to wane or recede, and it may come back, but you don't know. The important thing is that you need to pivot at the right point and just keep on finding new paths that will lead you up. Now, whether that means making money or just gaining experience, I don't think it necessarily matters. I think what matters is that you enjoy what you're doing.
Amen. So tell us how you're enjoying yourself now. Let's get out of the time machine and talk about what you have on your screen here. And
so one of my other mentors that kind of led me into this and into systematic stuff is Perry Kaufman. And I don't know if you've ever interviewed Perry before. I
haven't.
But Perry is largely considered, like the godfather of systems trading. He taught me a lot about, what works and what doesn't. And so I helped him. I actually helped him edit his most recent book. And while we were working together, we were working on ideas for, creating systems that could be approachable to retail traders. And that's, of course, it was a little self-serving, but at the same time, I wanted to be able to share this with some people. And that's what I do now. I trade clients' money and my own money, and I also take on a few people every month to teach them the system that we do. And so almost everything that I do is automated. I follow one crucial principle in automation that seems to work. And I don't want to say it's the holy grail, but if there were a holy grail, this is probably the closest thing to it, unless you're doing some front-running arbitrage and high-frequency trading, which seems to be the holy grail. Unfortunately,
right.
You need tens of millions or hundreds of millions of dollars to enter into that game. And that is that trading multiple strategies, diverse strategies that are non-correlated. That is the holy grail. And so everything that I do is developing a system around developing strategies that are non-correlated and running as many of them as I possibly can.
Yeah, first time I've heard this, Ernie. It's
Really?
it's eye-opening. Okay, so the fact, yeah, because a lot of people most likely run correlated systems that have relative performance depending upon which system, but they're all pretty correlated to each other.
Sure.
So
well,
you went the other way.
Yeah, so I agree to, and those are two very good ideas because there is efficacy in both. Now, I also do some correlated strategies, but those are always in the context of doing a statistical arbitrage. So you're looking for two correlated things, and you're playing the relationship between those two things. And having a close correlation is very important so that you can so that any kind of divergence in that relationship can be measured statistically, and you can take advantage of it by going long the underperforming and short the overperforming.
So you look for reversion on those strategies.
Exactly, and that's exactly what the knob trade is. And there are other trades that I trade like that, like the crack spread or the crush spread. The crack spread being an energy spread between oil and heating oil, oil and gasoline, or heating oil and gasoline. All of those things are very highly correlated. Or the crush spread, which is the spread between soybeans and soy meal or soy oil. Another pair that has very high correlation. And I'm sure that there's many equities that have a high degree of correlation. I just find futures a much more vibrant and an easier and simpler way to trade that type of stuff. So I agree 100% that a highly correlated pairs in that type of strategy is really important. But it's also a very difficult way to earn a living, only because every once in a while, like I was mentioning with the knob trade, the trade goes away. So what do you do then? It's not like it's not like that high degree correlation strategy, that arbitrage strategy is there all the time like clockwork. Things like, well, what's happening today in the market, at least to my best guesstimation, the reason why the knob trade and a lot of other trades aren't working right now is the extremely low volatility.
Okay.
Volatility kicked up a little bit recently, but then receded again. And when it did, for a moment there, the knob trade came back for one trade, which was crazy. But
okay, so the suppression of volatility is affecting the knob spread, and probably not as much commodity related spreads like the crush and the crack.
That's correct. Those are more dictated by other forces. I wish I could name them all.
Mother Nature instead of Mother yelling.
Yeah, exactly. Okay. So there's inherent volatility in those markets that make those more vibrant and more regular to trade, that are outside the some of the normal forces that are happening in the market. But they have their issues too. I mean, you have to be kind of take a longer term view on those trades, and that's what I'm doing, because they have these huge wide swings.
What does AITR stand for, Ernie?
Well, originally that stood for Apple Investor Trading Room.
Okay.
And that's a whole story that I skipped over. It was a blog that I had for several years called the appleinvestor.com blog. It doesn't really exist anymore, but it was kind of seminal to my getting into automated trading, because I had lost a lot of money, and I started the blog as sort of a way of spiritual redemption and looking for answers and trying to gather other people's opinions. Okay. And so, for a long time.
Did that help you? Because, you know, Ernie, personally, I'm a big believer in intelligence gathering and social trading. And, you know, there's times I could wake up in the morning, I'm not automated, I'm pretty discretionary, and not have one idea. And we only have two eyes. And when you surround yourself by with traders that are better than you, just, you know, the sharing of information like you were doing with that blog is a big edge for me.
Well, Dale, that's how I found my mentors.
Okay. Right. So, and you know what? That's how people find them here too. And how I found in working with a team, you know, that have different methodologies, and when they're all looking at perhaps the same type of outcome coming from different styles, it's to me like a confluence. Do you get confluences with your automated trading where, or it's just like, you know, it's go. When it's green, it's green. When it's red, it's red. Or are there ever situations where you can see several different things lining up on your, you know, on your automatic trading and your algos?
Well, I wish it were that easy. You know?
All right.
You know, and see, that's the thing. When people take on automated trading, it seems like everyone's looking for the rock star strategy, right? And they're going to figure out how to build it, or find somebody else that's doing it and then recreate it or re-engineer it or whatever. And
how about just plagiarize it?
Yeah, well, you know, and there's really nothing wrong with that belief. You know, that may sound a little weird, but if you take a lesson from someone like Steve Jobs, you know, perhaps the greatest entrepreneur and pseudo-technologist or marketer ever to come about, he felt that the reason for their success was to be able to steal ideas and then make them their own. The Macintosh itself was an idea stolen from Xerox PARC.
Sounds like Zuckerberg too.
Sure. I mean, there is nothing wrong with that, as long as
Bill Gates. So a lot of these guys, right? I mean, they weren't original thinkers, but they were strategic thinkers, and they saw the potential of something that others didn't.
Yeah, so I think that there's absolutely nothing wrong with stealing ideas and then making them your own. That's how we all
like it. I don't like it.
So the problem now is that people getting into automated trading, they're trying to find that cool rock star strategy. The problem is that there is no strategy out there that lasts forever, and being able to recreate somebody else's strategy, it can be fraught with peril, because you don't know all the machinations that they went through to get there. So you might.
And that's a great point. And markets are ever changing, so you have to always be. It's an ongoing process, probably for you with your auto trading, that you have to be tweaking it. Do you tweak it?
Well, see, that's the problem. You know, where's the amount of effort that you want to put in to get the greatest return? And is it in tweaking your rock star strategy and try to keep it going while it's losing money and you're trying to figure out how to make it recover? Or is there a better way? And I truly believe there is a much, much better way. And that is that you don't need to create a rock star strategy. As a matter of fact, it is a lot easier to create really simple, okay strategies. And you can come up with these, you know, 1, 2, 3, 4 a week with no problem. And they may last for a little bit, for a while, you know, who knows? And I don't really care. All I care is that they're okay performers and they were simple. The key, though, is what I said before, and that's this holy grail, that you can then take those really simple strategies and put them together. And here's the really cool part. When they have a low degree of correlation, what happens is when you combine their equity returns, the drawdowns tend to cancel one another out because they have, well, their returns are non-correlated, meaning that when one is going down, the other one might just as well be going up. Right. And so the drawdowns become diminished. And if all the strategies are generally profitable, no matter how profitable they are, their profits are additive. And so the effect is you can take a bunch of very squiggly equity curves and put them together, and they turn into this beautiful smooth equity curve that just goes straight up.
Well, you know what, Ernie, you're the first rocket scientist I've ever interviewed, and you know, your journey was really interesting, and talking about, you know, it's not all blue sky, and all the different things you went through. Jake Bernstein, I don't know if you remember him, used to call character quality that you have as stick-to-itiveness. I mean, you stick to it, you don't lose till you quit, and your persistence, and, you know, having to go through things as, you know, in your, you know, what was your original vocation, and see that change, adapting. And the adapting that you went through there, I think, gave you the training to adapt to changes in the markets. And really, I'm glad I reached out to you on Twitter. And if you'd like, Ernie, you could show your website so people would know how to find you if they have an interest in this. And, you know, perhaps, there we go. What kind of trader are you? Okay.
So it's traderoffutures.com.
Right,
and, yep. Like I said, I take on a few people each month to teach in this system. I really don't have the time to do anything other than that, because all the training that I do is one-on-one. I don't give people a course and then maybe talk to them for 15 minutes. It would be just like this over GoToWebinar or Skype, and I talk to people individually. And so I really don't have the time to take on a lot of people, but I want to make sure that anybody that I do take on can benefit from that one-to-one sort of a mentorship type of relationship.
Okay. And is there, besides that, any other offerings? You have products, I see, and you hold webinars, and you have a blog up there.
Well,
so,
I'm going to be doing a webinar with TradeStation next Tuesday, okay. But I don't have any of the information yet on my webinar page. I just created the webinar page, and I'm starting to do more webinars. Okay. That, you know, but if you go back to the site, you'll start seeing more webinars being listed there. Right now, there are none.
Okay, Ernie.
You know, I don't have products. Like I said, I trade client money, I trade my own money, so I don't have. I'm not in the business to try to sell products, but I do want to help some people, and I'm willing to take on a few people.
Okay, Ernie. Well, thank you so much for being with us today. It was great to meet you, and thank you for opening up and sharing your journey with us and your philosophy of trading. It was a great interview. I wish you nothing but success for you and whoever you touch with your words and your teachings, that they achieve what you have with less pain.
Yeah, that's it.
That's my hope.
Yeah, mine too. Right. It's a great way to go.
All right, thank you, my trading warrior brother. Ernie, you can follow Ernie at Trader of Futures, and you're looking and you heard a veteran guy. There's probably not much he hasn't seen. Thanks again, Ernie.
Thank you, Dale. Take care.
Thanks everyone. Thank you, F.A.C.E. Thank you, investing.com, for participating in our webinar today. Everyone enjoy their summer day, and most of all, remember, don't just count your pips, count your blessings. And we'll be back with you tomorrow to wrap up the week. Adios. You're welcome. You're welcome, guys. Glad to serve. Our mission here every day is to edify and build up traders. Adios.